If he asked you to leave, would you go?
No.
The Fed chair's defiant message to Donald Trump after cutting interest rates by 25 basis points. Live from Singapore, welcome to Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks catching a tailwind from the U.S. as the post-election rally gets a boost from that Fed cut. Investors also awaiting the outcome of a key Chinese political meeting for details on fiscal stimulus as fresh Trump tariffs loom. Well, it says the impact of all of this on bond markets, speaking exclusively with Pimco MD and Asia-Pac head Alec Kersman, plus the view on geopolitical shifts under Trump Mach 2. Former Indian Ambassador to the U.S., Meera Shankar, joining us live. And with India's wedding season around the corner, we get exclusive insight on the travel sector with IHCL CEO Puneet Chhatwal. Well, Asian equities climbing after stocks, bonds and commodities all rallied in the U.S. as the Fed cut rates again. Investors also keeping an eye on the big meeting of Chinese lawmakers in Beijing, expected to approve a fiscal stimulus package worth trillions of yuan. More on that later in the show. Let's take a closer look at the market reaction to that Fed decision with Avril Hong. Of course, we have global stocks at a record high.
Absolutely, Has. That 25 basis point cut by the Fed as expected. But along with how Powell talked about the strength of the U.S. economy, enough for investors to be put in a pretty good mood. So you saw not just the climb on the all-world index, the global gauge for stocks, the U.S. When you look at the S&P 500, the NASDAQ, that also hit fresh records. Asia following suit, and we're seeing that climb not just in stocks but bonds, Asia currencies, recouping some of the lost ground from earlier in the week as well. So you also get the sense that there is a bit of recalibration of the initial fears about what Trump would mean for inflation. Let's take a closer look at what we're seeing on the US 10-year though, because despite the rebound that we saw overnight, and you consider what we saw earlier in the week, it does look like a really modest comeback. And indeed, traders are paring back their bets about Fed rate cuts next year, given the relative economic data that's been coming in looking quite strong, and of course, the US election outcome. Now, flip the board and let's rake through what Powell said. As you know, he didn't give very much away about the timing of the next cut, December, not ruling that out or in. So the focus, and this is something that our M-Life strategist Mark Cranfield has been highlighting, will be on the Fed speak in the next couple of weeks, particularly if they say anything about inflation, more so than the focus that has been recently about the jobs market. Now, we also heard from Powell talking about debt levels in the U.S. economy. Have a listen.
The U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable.
The concern surrounding that, certainly about whether Trump's policies could inadvertently drive up the deficit somehow, and whether the market can absorb the ensuing supply of treasuries potentially, Haas.
That's right, and it's about how Trump's policies are likely to be inflationary. Avril Hong, thank you so much for that. Now, the impact of Donald Trump's victory in the U.S. election continues to play out in the markets, including the prospects for further rate cuts by the Fed, as he begins putting his top team in place, announcing his pick for White House Chief of Staff earlier today. Investors are trying to gauge the shape of things to come. Let's get insights from Alec Kersman, MD and head of APAC at Investment Managers Pimco. Well, we heard, Alec, how it is hard to predict what Trump might do, but you have some suggestions, perhaps, on day one, what we might see.
Yeah, well, first of all, thank you for having me. It's great to be here. So look, there's a lot that we could talk about in terms of the election and kind of what has been going on. But I think that on day one, there's a few things that Trump could be doing. I think number one, he could be rolling back some of the executive orders from Biden, particularly in the energy sector. Think about things like the ban on exports for liquefied natural gas, LNG, maybe even allowing for drilling on federal lands. He could also potentially be issuing new executive orders. So in the area of immigration, we could see some action there to kind of start rebuilding the wall or restricting immigration or even instructing the Department of Justice to prioritize criminal prosecution and deportation of immigrants. Now, anything bigger really than that, that has been talked about in the campaign will require Congress and logistically really difficult to do on day one. Maybe the biggest thing that he could do on day one is use Section 301 investigation to increase tariffs on China. And so this is the same tool that he used in his first term to establish these tariffs. Biden used it again to increase the tariffs, and it could be used again to add another round. Broader tariffs will take more time and will require Congress.
The thing is, any tariffs, they say, would be inflationary, and that is what the Fed is looking at, CPI. If there's any indication that data, when it comes to CPI data, is sticky, well, it may impact how it moves forward. What do you see the Fed doing in December in 2025?
Yeah, absolutely. And we saw a little bit of that hit in the markets this week. I would say that the reaction of markets this week has been broadly in line with expectations for this outcome. We've seen, the U.S. dollar appreciate. We've seen, higher equity prices. We've seen steeper curves, and steeper curves have implications related to your question about inflation. We've also seen bond yields sell off a little bit, and we're talking about just now, and a little bit as well of inflation expectations creep up. So I think all of this is in line with a kind of reflationary trade. But as we have seen today, once the euphoria of the election starts slowing down, there could be a little bit of a slowdown that as well. I think that the Fed, the 25 basis points that we saw today were pretty much priced in. They weren't too much of a surprise. And we believe the Fed. We believe the Fed has a commitment to bringing inflation back to their target. And to the extent that incoming data starts being stronger in terms of growth or in terms of inflation, we think that they will act. And that could mean maybe less cuts, or it could mean even going the opposite direction if necessary. So we believe them.
We talked about how yields have eased a little bit, but the trend is possibly higher. Have yields peaked, though?
Yeah, look, yields can go a little bit higher, it can go a little bit lower on a tactical basis. But at the end of the day, thinking about valuations and thinking about the Fed acting in the background will create a cap on how high yields can go. So we believe that there is potentially still a little bit of room for cuts. Now, the December cut will depend on the incoming data. As you know, we've seen a little bit of mixed data over the last few weeks, stronger growth numbers for the U.S. We have seen, inflation data maybe moderating. We have seen unemployment employment numbers slowing down as well. But the data was pretty noisy because we had the Boeing strike, we had 2 hurricanes hitting the U.S. And so, but even if you extract a little bit of that noise, our view is the information in terms of came out of the latest employment numbers is that employment is weakening in the U.S.
The thing is, if yields continue to trend upwards, it does seem like bonds then become quite a safer investment versus stocks. I mean, how do you position for this?
Yeah, we think it's an incredibly exciting opportunity right now. And if you take a step back, we are at a place right now where yields are higher than they have been at any time since 2019. And I think that is the real point that investors should think about. Again, taking a step back, you say the economy is today more normal in a way that it has been at any time since 2019. And so if you think that the economy is more normal, the level of yield seems to be abnormally high. And so what the Fed and other central banks, with the notable exception of Japan, of course, are trying to do is to bring those yields down towards neutral. And the key question is, what is neutral and how fast you get to neutral?
Alec, it is about the Fed, it is about Powell. Powell was asked whether, he would buckle under the pressure of Trump. Let's take a listen to what he had to say.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Quite defiant. It is quite important as well that the Fed remains independent.
Yeah, I think it's a very critical point, and I would tell you this is the probably most asked question that many of our clients ask us. What will happen with the independence of the Fed? Look, we think that it would be a really extreme situation for something to change. As you know, Chairman Powell has his seat until I think it's May of 26. And we would be extremely surprised if there would be any action that would force him out without a cause. And so we believe that the Fed will retain its independence. There's institutional guardrails around this that protect the Fed, and we don't think that's a risk, at least in the foreseeable future.
Well, like Alec, staying tight, more ahead with Alec Kersman, MD and head of APAC at Pimco. Well, still ahead this hour, we'll discuss how Trump's win could impact U.S.-India ties with the former ambassador to the U.S., Meera Shankar. We'll get the outlook for the hospitality industry with the CEO of India's IHCL, a Tata unit that runs luxury Taj hotels. Keep it here with us. This is Bloomberg. Well, after the U.S. election and the Fed, it is about China and that MPC meeting. Chinese shares headed for their best weekly showing in a month, helped by hopes that authorities may unveil stronger growth stimulus when the NPC Standing Committee meeting concludes today. Taking a look at where we are into the CSI 300 index, down a tad by 0.2%, but for the week, it is up about 7%. Now, lawmakers there got a head start on the U.S. election this week as they gathered to vote on what is expected to be the largest fiscal package since the pandemic. Chief North Asia correspondent Stephen Angle is in Shanghai and joins us now. Steve, what's at stake for Beijing with this stimulus package, especially now that Trump is back?
Yeah, we're definitely all in a holding pattern right now as we approach midday here in Shanghai for news from Beijing as that National People's Congress Standing Committee wraps up the week-long meeting. Well, 5 days. They began on Monday talking about a debt ceiling and essentially a debt swap program that could be, economists estimate, to the tune of 6 to 10 trillion yuan. That's more than $1 trillion US to kind of free up the coffers, the fiscal constraints that are at the local level in China, and to kind of really clear that hurdle for now. I mean, the hidden debt, the off-balance sheet debt at the local government finance vehicles is estimated upwards of 8 trillion yuan, more than $1 trillion US. So, excuse me, 8 trillion US dollars. But that's not what they're going to tackle and bite off right now. In addition to that, what other kind of fiscal stimulus could we get? And you mentioned, obviously, the wild card being Donald Trump and the potential of 60% tariffs across the board on all exports to the United States. That would undermine, obviously, what has been a singular, if you will, main pillar of the Chinese strength right now, with property down and consumer confidence so down. The exports have done really well, exemplified yesterday by that 12.7% rise in U.S. dollar terms for October exports on the back of course, that stimulus, the first round of stimulus that we got at the end of September. But imports were down 2.3%. Guess what that did, Haslinda? It exacerbated, it widened the trade surplus that China has with its trading partners to the third highest monthly total on record.
Well, expectations are high, stakes are high, and we have been disappointed time and time again. What specifically can we expected to hear today?
Yeah, this could be a case of, as we are all in that holding pattern I mentioned, there's so much expectations for a big fiscal number, if you will, because, again, the National People's Congress, which is the national legislature in China, is the only one really with the authority to approve this kind of extra spending and, again, raise that debt ceiling. So if they disappoint, say, for example, they stretch out that money over 5-7 years or whatever, if they wait as well for, to digest what the implications of that Trump tax, if you will, the increase in tariffs, what's it going to be? What are the negotiations going to be like? Will it come down? Most people expect it's not going to be across the board 60%. Trump will wiggle a deal somehow with the Chinese and bring it down. But still, they have to account for that. So one of the things that Ding Shuang at Standard Chartered is talking about, because of the Trump victory, because of the prospect of those tariffs, we could see an extra 2 trillion yuan more of outlays, of fiscal outlays in this package than previously expected before we knew Trump had won the White House. And again, I do not think it's a coincidence at all that the National People's Congress Standing Committee is holding their meeting this week, not at the end of October, where it's usually held at the end of every 2 months. They waited to see what could happen with the presidential election.
And of course, China kept its powder dry. Our Chief North Asia correspondent Stephen Angle in Shanghai, thank you so much for that. Alec Kersman, still with us, MD and head of APAC at Pimco. Big and bold from China, perhaps?
Perhaps. As you said, I think the expectations are very high. And so I think we need to be careful with that because if there's disappointment, it could be counterproductive. And the other aspect of this is how much does the National People's Congress want to deploy, bazookas into lack of perfect information? In other words, like, we don't know if Trump is going to do 60%, 50%, 20%, what is the tariffs? So I think that maybe waiting for some information could also be wise. Look, our view generally is that China in 2025 will slow down. We think it's going to be somewhere in the range of 4 to 4.5%. It's not dramatic, from the 5% in the previous couple of years. And we think that the first round of stimulus was quite effective in targeting asset prices, in maybe creating a little bit more of an optimistic view about the future of China. But we have to wait. And I think this second package will be critical in terms of what the future looks like.
Interesting that you're expecting a slowdown in China, because some economists say we'll begin to see the impact of the stimulus in 2025, hence that would help boost growth.
Yeah, I mean, look, that's probably true. I think we have a high level of expectation that the tariffs will go up for China. And look, at the extreme, if tariffs were to go up, say, early on in the Trump administration by 60%, that could have an impact in the range of 2 to 2.5% of China GDP. So the impact could be significant if it was so extreme. Now, on the other hand, of course, we've got the stimulus that could add another 1.5% in terms of growth. But it's just not so clear. So, yes, there might be some implications of the stimulus that we've seen in September, the one we're probably going to see in November, but just not so clear to us. And we think that the impact of the tariffs could be significant in the first year.
So how do you play China, and how attractive would, Chinese bonds be? High yield bonds, they did pretty well not too long ago.
Yeah, we play it cautiously. We play it quite cautiously. We think that still it is not clear to us that China has been able to kind of navigate out of the cycle that they're in. And if you look at history, you see that it takes time. It's taken time to Japan. It's taken time to the U.S. From their own property booms and busts. And it will take time to China as well. We need to see some of this really percolating into income generation, property prices, et cetera. And we're still not there.
That's the impact on China. How about the impact for the rest of Asia? For instance, I mean, how attractive post-Trump, post-election, IG markets are in Asia?
Yeah, look, I think there is a potential for them to be quite attractive.
Where in particular?
Yeah, so for example, we have some positions in India that we think will continue to tighten. That's been quite interesting, and we've seen some of the local players also kind of increase positions, which is helpful. There are other markets, around Indonesia and so forth that we think are also quite attractive. But if you step back for a second, you think about Asia more broadly. Japan kind of is going through their own interesting situation, both on the political front and on the economic front. And so, as we know, the kind of majority coalition of DPL and Komeito failed to achieve majority in the recent election. We think that Ishiba will continue to stay as prime minister in Japan, although they will have to negotiate in Congress to get past some of their. So that will mean more of an expansionary fiscal stance in Japan. On the rate side, it's still to be seen what are the implications, but our view would be that we expect another rate hike maybe in the beginning of 2025.
So still a lot of uncertainty, not just in Japan, in the US and China. When you take a look at your clients' appetite for risk and how they want to deploy their capital, I mean, what are we seeing? What are some of the trends?
Yeah, so we've seen, I think many clients are saying, hey, rates are at a level today that we haven't seen in many years, and it's an incredible opportunity to lock in some of these yields for the long run. Now, that is not across the board. I'd say that we've seen a significant amount of flows into traditional fixed income, things that are yielding, 4, 5, 6, maybe 7%, maybe even more at the current level. So we've seen a lot of flows, and this applies to the institutional world, but also to the wealth management world. So a lot of flows have been coming in, particularly during 2024. A little bit different in places like Japan or even Korea, because the hedging costs of buying kind of non-local fixed income and hedging it back to local currencies has been significant. So in Japan, around 5%, 2% in Korea, and so forth. So we have seen a lot of demand for traditional liquid fixed income, one of the best opportunities that we've seen in a long time. But we have also seen interest from clients moving into the private space, into private credit. And this it's fascinating, and I think we have a really great vantage point from Pimco, because we're able to see the public and the private, and we've been doing this for a long, long time. And so the ability to look at relative value between public and private gives us a lot of credibility and trying to make that decision in an unbiased fashion.
But given that so much is headed in the same direction, what risks do you see there?
Yeah, so that's a great question, because there has been a lot of capital formation going into private credit, but particularly into what I would call corporate direct lending. So that is kind of leverage finance. There's been kind of literally trillions of dollars over the last 10 years going there. And we see some concerns there. We are cautious with what we call the more sensitive areas, economically sensitive areas of the market, and there's no need, and the bar should be high for clients to go into higher risky areas when you can get high quality global fixed income at 6-7%, maybe even double digits if you see more Fed action that is expected.
Alec, just one final question in about 20 seconds. I'm just wondering, what is the asset that you must hold in 2025, the best returns?
I think asset-backed lending. That's where you should go. That's where our more sophisticated clients are looking at. Incredible opportunities as the banks step back, and there's a lot of value to be created in that space.
All right, Alec, good to have you with us. Come back. Alec Kersman, MD and Head of APAC at Pimco. Still to come, a veteran Indian diplomat sees stronger strategic ties between New Delhi and Washington under Trump's second term. We'll get more insights from Meera Shankar, who served as India's ambassador to Washington. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Markets are awaiting the outcome of China's legislative meeting that wraps up today. April stocks there have pretty much a solid run.
They have. I mean, if you take a look at the CSI 300 and its performance in the past month or so, it is actually pretty impressive that it's managed to retain most of the gains from late September. Remember that monetary stimulus blitz. And then you take a look at what we're seeing this week. It's headed for its best week in about a month. And they're actually trading volumes behind this, which signals to you that it's really up to the Chinese MPC to kind of fill in the blanks and to show that there are these fiscal policy moves that will help to revitalize the Chinese economy. And if you look at these trading volumes and the outperformance of the Chinese stock market, you flip the board and take a look at how it's been faring versus the stock market of India, based on the MSCI India as well as the MSCI Japan. It also gives you a sense of how important the sense of urgency that stimulus measures coming through from the MPC really is, because not only is this outperformance quite prominent, given the threat of Trump's tariffs, it gives you the sense that, that really needs to materialize in order for Chinese economy to get that buffer. Remember, some of the estimates that we're getting is for a 2 percentage point knock to Chinese growth against the backdrop of those potential Trump tariffs. But something that could also kind of adjust the trajectory of Chinese, India, and Japanese stocks, given what Trump's policies would mean. Keep in mind, when you look at Japan, it's seen as a beneficiary potentially from these Trump's policies that might be reflationary. What would that mean for the greenback and the yen weakness that typically benefits the nation's stocks? And then think about how India is seen as an alternative to the manufacturing hub of China, and it's also seen as relatively immune to the global risks, given how it's very domestically driven as an economy, Has.
Well, that's right, but remember that Trump 1.0 saw tariffs being imposed on India as well. Avril Hong, thank you so much for that. Now, one of the first world leaders to call and congratulate U.S. President-elect Donald Trump was India's Narendra Modi. And our next guest is a former Indian ambassador to the U.S. Meera Shankar led India's mission in Washington between 2009 and 2011. Meera, good to have you with us. How do you see Trump 2.0 affecting, shaping relations with India?
Look, I think the broad strategic trajectory of India-US relations will continue to grow and strengthen because there is a convergence of interest in the Indo-Pacific about how to shape a balance in the light of an increasingly assertive China, which can also sometimes be aggressive. So that, I think, will continue to bring the two countries closer together. Having said that, there could be challenges on the trade front because President Trump has said he will impose an across-the-board tariff of 20% on all imports to the US, so that will impact India as well. He has also said that he will put much higher tariffs, 50 to 60%, on all Chinese imports into the US. Now, we have to wait and see if he implements this or if he implements it selectively. But this could also provide some opportunities for India in the light of the policy being followed by Western business to de-risk from over-dependence on China. It doesn't mean that India is the only country which stands to benefit from this. There are other countries in play which have got FDI as part of this China plus one policy. Right. And include Vietnam, Malaysia, Indonesia, Poland, Mexico. So it depends on how international businesses see the business climate in India.
Do you see Trump and Trump policies forcing Modi's hand, perhaps even forcing him to cut import levies?
I don't think so. I think the BJP government has also adopted a somewhat nationalist policy on trade. And given the fact that India is trying to jumpstart manufacturing here, because we are largely a services-driven economy, and that's not creating enough jobs, that I think that this is likely to continue. India will have to deal with President Trump pragmatically. And the last time,
Right.
he imposed tariffs on steel and aluminium imports from India, we had negotiated with the US for 2 years before imposing
Right.
reciprocal tariffs. So I suppose the effort would be to try to find some pragmatic way forward. During the Biden administration, the two countries were able to resolve 6 of their WTO disputes bilaterally. So we'll have to wait and see.
Meera, on the security front, do you see the U.S. impacting relations between India and Canada? Might the U.S. weigh on that?
Well, President Trump has generally not taken a very interventionist approach. But on the whole issue of Sikh support for a separate state in India and incitement to violence in India, funding of violence in India, he may take a more indifferent approach, because he has said that he is not going to make human rights or democratic freedoms a core priority for his foreign policy approach. So that could certainly weigh in. And Canada does take signals from the US.
In terms of the Quad, of course, India, part of the foursome that make up the Quad. How do you see that relationship developing?
Look, Biden has imbued the Quad with a lot of importance. He's elevated it to summit level, attended all the summits, either virtually or in person. Now, the question is, will Trump give it the same importance? He might, because he's the one who resurrected the Quad, and meetings were held at foreign ministerial level during his term. So he might see it as his initiative, but generally he has not been very inclined towards institutional arrangements for pursuit of US policy. So, that was Biden's approach, building coalitions across the Indo-Pacific. There was Quad, there was AUKUS, there was the China, Japan, South Korea trilateral, there was the defense agreement with Philippines, and in West Asia, there was the India, Israel, UAE, US foursome.
But Biden also agreed to technological transfers with India. Do you see that continuing under Trump?
There could be a question mark, especially, well, I think the GE F414 deal for manufacturing jet engines jointly in India with HAL, which will power the Mark II Tejas aircraft, which India is building on its own, will probably continue. But the ISET, the Initiative on Critical and Emerging Technologies, which is more amorphous, creating an ecosystem of business, universities, research institutions, I think that really requires the oxygen of government interest. And here we had the two NSAs steering it. So it got that kind of push. Whether the same enthusiasm for it will remain or whether Trump will pull back is a question mark, because he hasn't said anything on it. But overall, he has been a to technology transfers, technology sharing with other countries, saying, why are we doing that? We should be selling.
Linked to that is Indian talent mobility. Meera, we know that Trump wants to bring the manufacturing sector back home. He's looking at making America great again. How might that play out in terms of talent mobility? How might that impact Indian talent in the U.S.?
There are a number of Indians who go to the US to pursue higher education. Many of them immigrate legally to the US. There are also Indians who go on H-1B visas in pursuit of contracts which Indian companies have with US companies, and also in pursuit of filling skill vacancies in some of the largest US companies. So it's not just the Indian companies who use the H-1B visa process. It's all your tech companies, Microsoft, Google, Facebook, what have you. All of them use Indian skill and talent under the H-1B program. And that's because there is a skills gap in the United States as well. Your unemployment rates have been at record lows.
Right.
I think they were 3.3% under Biden, now gone up to a little over 4%. And there is a consistent skills gap. So yes, Trump may make the process of getting H-1B visas more cumbersome, though he himself has made conflicting statements. He says we welcome legal immigration at some stage. And then he's also said that those who have master's degrees in the sciences or technical areas could stay on for a year to work. So we really don't know with what severity he's going to crack down on legal movement as well as illegal immigration.
Meera, we have to leave it there. Thank you so much for your time. Meera Shankar, former Indian Ambassador to the United States. Now, coming up, we'll get insights on how luxury travel demand is holding up in India. The CEO of Taj Hotels operator, IHCL, will be joining us exclusively next. Keep it here with us. This is Bloomberg. Welcome back. U.S. trade policy under a second Trump administration has been a big talking point this week. The potential impact on both consumers and sectors is huge. And it's not just China that has a lot at stake. Joining us exclusively from Mumbai is Puneet Chhatwal, CEO of IHCL, the group behind some of India's best-known hotel brands, including the Taj. Puneet, good to have you with us. I mean, what's the sense on the ground among businesses like yours on the Trump's administration's impact possibly on India?
Well, generally the sense is positive, but when it comes to our sector, it's driven more by the balance between demand and supply. And demand remains very strong. Supply is constrained because of COVID. There's a lot of catching up happening now. It'll take at least 3 years for that balance to play out maybe in favor of supply, but for the next 3 years, demand will continue to outpace supply.
But how strong is that demand? Quantify that for us. I mean, what kind of numbers are you seeing in terms of demand for luxe travel versus a year ago? And what are you anticipating for 2025?
Well, all our brands from luxury to the mid-market have shown a double-digit growth in rate. But obviously the strongest is the luxury segment. That is also because of the brand itself. Taj is not just an iconic brand of India, it's an iconic brand for the world. And the ability of Taj brand to charge more or to get through any kind of headwinds is very, very strong. It's a matter of pride for most parents to have their children get married at the Taj, which is a very big part of our business, the wedding business in India. We have these iconic palaces and all these assets in the key metros with great locations. So I think Taj is obviously leading, but others are not far behind. So at all levels, because of India's GDP growth, because of India's businesses growth, because of leisure demand growth, which is in double digit today, when I look at the last 6 months, and with foreign tourist arrivals still lagging behind the pre-COVID level, I think the best is yet to come, and the hotel sector is very well positioned.
You talked about weddings. We're looking at 5 million potential weddings. What is that translating to in terms of revenue and profit for you? How important is this market? How much of it are you securing?
You know, when it comes to the Taj brand, amongst our entire brandscape, 25% of the Taj revenue is driven through the wedding segment. How you divide it between how much is food and beverage, how much is rooms, that's very different. And of that 25% revenue, the conversion rate is easily 50% on wedding business, because that's something most Indians look forward to in their lifetime to celebrate that occasion. It's not just an occasion for the couple that is getting married. It's really a social event in India where all the families and the friends and everyone else gets together, and also that's how the relationships have been maintained over decades and generations.
We hear that the upper middle class is splashing, but the middle class isn't spending too much. How are you addressing that issue? How are you making your hotels attractive to the middle class?
Well, we have come up with new brands in this segment. We have reimagined the Ginger brand. We've just added a Tree of Life, which is small, experiential boutique hotels to address the needs and wants of the tier 2, tier 3 markets and the so-called middle class. But generally speaking, you know, it's all a functionality between disposable income and the desire to experience something new. So whether it's middle class or high middle class or luxury or whatever, I think it all depends on what the event is, what the occasion is, and how you want to celebrate. But the good news is today our brandscape is diversified enough to address needs of all customer segments that are available in a heterogeneous country like India.
Internationally, in terms of your strategy, what are you looking at? You expanded in Bahrain. Are you looking at more markets?
We will be opening, we just opened last week a hotel in Bhutan. We are opening 2 more this year. So Thimphu is what we opened. We are opening in Paro and Phobchika. In the next 10 months or in 10 months from now, we'll be opening our first property in continental Europe in the city of Frankfurt, the very famous and iconic Hessische Hof, which will be joining us. It's currently undergoing renovations. We are also looking at other opportunities both in Western Hemisphere as well as in Southeast Asia. Hopefully by next quarter, when you invite me back, we'll be able to share that news with you too.
We will definitely have you back. But I'm just wondering, you know, which are the strongest markets? You talked about how you're expanding in Europe. Europe is undergoing a slowdown in terms of growth. You talked about Asia possibly, you know, experiencing strong growth. I mean, how are you looking at the outlook for growth and how you're positioning in terms of those regions?
Europe is Europe and is there to stay. It may undergo now a downturn, but that is the opportunity. You don't enter markets with any kind of risk, and we're not buying these assets. This is just an operating lease in Frankfurt. The hotel investments, in my opinion, are anti-cyclical. So you should enter when the market is not at the highest level and probably is a little bit soft, so that by the time you finish renovating and you finish repositioning the property, which will be like if you open Frankfurt in 10 months from now and it takes another year and a half for it to settle down through the beginning phase, then we are talking about 2.5 years. And I think in a market like Frankfurt, where Indian businesses are so strong, German businesses are strong, all the banks are present there, the long-term outlook, the mid and long-term outlook of Frankfurt remains strong. So it's a good time to enter the market now.
Right. So how many properties do you think you'll be having in the next 2 years, given the optimism?
Well, I don't know if you want to know properties across our portfolio, then we are having a pipeline of 120 hotels. And we plan to open this year 25, of which 14 we have opened, another 11 to go. Next year it will be 30 openings, and the year after that will be 35. Of this, our focus remains on the Indian subcontinent. Internationally, we will grow very selectively with Taj brand in key gateway locations and markets. And so that means our international footprint outside of Indian subcontinent would be limited to a couple of hotels each year. And we are very pleased with that, because we feel very strongly that our strategic fit is only with the luxury positioning on the international front and not with all our other brands.
You talked earlier about how it's about disposable income, and increasingly Indians are traveling overseas. How are you capturing that market?
We don't need to make, thankfully, so many efforts. Obviously, we have all the distribution strategies, loyalty program, etc. in place. But, you know, when there is Wimbledon happening in London, then the Taj is full. And everybody who's considered as who's who of India is actually seen in the courtyard of Taj St. James Court and Taj Buckingham Gate. So I think the same is if the UN General Assembly is happening or any other important event is happening in New York, then you have the people traveling from here overseas wanting to stay at the pier in New York. So we are very blessed that the Taj brand, because it's celebrating 121 years next month on the 16th of December, is not something created now. So we benefit from the legacy of the Taj and the positioning that our forefathers gave. And what we're trying to do is just enhance it and keep it more and more, you know, strategic and more relevant going forward.
Speaking of positioning, Puneet, I'm just wondering how you're reorganizing your subsidiaries. What are you looking at? What's the strategy?
Well, the good news is most of our subsidiaries are also doing well, or are affiliate companies. And in the last 6 years, we did not benefit much from growth within those companies or growth coming from those companies. But now that they are in a very good position in terms of their capital structure, a lot of those subsidiaries will be adding to the growth of our portfolio. So we recently announced results of few of those listed entities, and they have also managed to announce growth within companies. And I think that's the added tailwind that our portfolio needed.
Puneet, thank you so much for your time today. Puneet Chhatwal, MD and CEO at IHCL. Now, before we go, here's a look at our guests for next week. We'll talk about the growth strategy of Indian conglomerate RPSG Group as we speak exclusively with Chairperson Sanjeev Gonka. Also dig into the outlook for the banking sector with OCBC CEO Helen Wong, and analysis on Trump's second presidential term and his energy policy with former U.S. Secretary of State John Kerry. That is it for Insight. This is Bloomberg.